One Up on Wall Street by Peter Lynch. Peter Lynch is a Wall Street legend. He managed Fidelity Magellan Fund since 1977 until 1990. His annual average return was around 30% for 13 years. If you invest $1,000 in his fund in 1977, 13 years later, your investment would turn into $30,000. The book opens with an impassioned argument from Lynch on behalf of seeking out a 10-bagger, which refers to a stock that increased in value 10 times from initial investment. Buy a stock at $10, when it goes to $100, you have a 10-bagger. Lynch makes a good point that if you buy 6 stocks, 5 of them go to zero and 1 of them is a 10-bagger, your rate of return is still 66%. Lynch's argument for individual stock investing is that you can occasionally hit the grand slam and make up big time for your losses. Preparing to invest. If you find a good stock, doesn't mean that you should own it. You should ask yourself 3 simple questions in the mirror before you buy any shares of anything. Question 1. Do I own a house? You should consider to buy a house before investing in a stock. House is a good investment that everybody managed to make. It's a money maker's 99 out of 100 if held for a long period of time. Question 2. Do I need the money? Review your budget before buying a stock. For instance, if you need the money to pay for your child's education, in this case, buying a blue chip stock is too risky. Sometimes blue chip stock can stay down for 3 to 5 years. If that's the case, then your child is going to go to night school. Only invest what you can afford to lose without any effect on your life. Question 3. Do I have personal qualities that will bring me success in stocks? List of personal qualities are patience, self-reliance, open-mindedness, persistence, humility, flexibility, willingness to do independent research, willingness to admit to make mistakes, ability to ignore a general panic. Ignore the analysts and experts. Instead of turning into CNBC or Bloomberg for the next hot stock, do your own research and find out the stock that you understand and believe in. Also, don't try to time the market or predict the economy. Very few people can do it, and most of them for the wrong reasons. The economy is incredibly complex. Don't get overconfident and believe that you know how it works. Instead, focus on what you know. Look at the companies and industries that you are familiar with. Start looking at the potential investment at your job or around your house. That's where you can find the potential 10-baggers before any Wall Street analyst. Do your own homework. You should seek out inspiration for companies to look into from your day-to-day life. Companies you observe doing a good business and attracting strong positive words of mouth. But once you have identified those companies, it's time to dig in and do the research. What kind of research? Learn everything you can about the company. What's the balance sheet looks like? Who is the management team? How they compare to similar company and the same industry? And so on. Here are the 6 big positive signs to look for. Number 1. Low price to earning ratio, especially as compared to similar companies. Number 2. Low percentage of institutional investors. Number 3. Insiders buying the company stock. Number 4. The companies buy back its own shares. Number 5. Is the balance sheet weak or strong? Number 6. A low debt to equity ratio, especially as compared to similar companies. Even if you have found a stock that really looks good according to those numbers, don't invest just because the numbers. Make sure you can describe why this business is a good business and why you are buying this stock. And the fact that the stock is going up is not a good reason. And the most important thing, if you do find a stock that you really understand and all numbers look great, the price has to be right. Buying the right stock at the wrong time for the wrong price and you will suffer some great losses. So how to find the right price? What is the intrinsic value of the stock? According to Peter Lynch, if the company's PE ratio equivalent to the growth rate, it means the company has a fair price. But it's even much better to buy a stock if the PE ratio is less than the growth rate. It means you're buying something at a great discount. When you bought the right stock, now you have to be patient. As long as your fundamental reasons for investing don't change, sit on that stock. Sometimes it takes years for the stock to truly take off. Don't put all eggs in one basket. It is dangerous. Find few companies that you can understand. On the other hand, diversifications, which usually turn out to be diversifications. Don't buy stocks just because you want to have a diversified portfolio. So this was the summary of One Up on Wall Street by Peter Lynch. I hope that you learned something new and something valuable. So thank you guys so much for watching.